orderly movement, especially at the short end of the yield curve. The markets obviously were expecting a status quo, so the impact was fairly muted as far as the short end of the yield curve goes. We saw an yields increase marginally in the band of about 5 to 10 basis points. The government securities market, or the G-Secs as we call it, had the biggest impact in terms of quantum of price fall or the yield rise. Now, this was largely given the outlook table to us by the Monetary Policy Committee, which basically sees some upside risk to inflation. Of course, the FY17 or the March 2017 target for inflation has largely been met, but the FY17-18 inflation target has been broken into two halves. First half at about 4.5%, second half at about 5%. This effectively means that the RBI sees some upside risk to the inflation projections of being able to achieve the 4% mark. Now, that obviously has not been good news for the markets, and even more important is, given the uncertainty on the global economic variables, as also coupled with the monsoon effects, the inflation impact and the transient liquidity, the RBI believes that the rates will remain in neutral mode for some time now. We therefore believe that incremental rate cuts in the near to medium term could not be something which could be conceivable. What should therefore markets look forward to going forward? Expect the markets to remain range bound, in line probably in the band of about 5 to 10 basis points, given the kind of sell-off that we have already seen right now. The 10-year government security benchmark is almost at 6.8%. The good news here is that foreign institutional investors have been continuous buyers, not only in the equity markets but also in the bond markets. January year to date 2017, we have seen almost 1 lakh crores of inflows by FIIs both in the equity and the fixed income markets. In fact, in the first 2 working days of April alone, we've seen approximately 10,000 crores of FII flows into the bond markets. This, we believe, will keep the yield rise under check, with incremental buying coming in from foreign investors as also some investors in the domestic segment. What should be the outlook going forward and the strategies that investors should focus on? In this kind of a scenario, we have been quoting for quite some time that short-term or credit accrual-based strategies seem to be the best fit for an investor seeking exposure into fixed income. Ultra short-term kind of strategies also would probably be a better suited investment avenue over liquid funds, where the yields are at abysmally low levels, and we believe will continue to remain that way going forward. Should one look at duration funds like gilt and bond even right now? Well, we believe that these funds come in with inherent increased volatility given the longer nature of the duration that they have, and therefore a buy on dips could be a potent strategy, probably as a tail end allocation to your fixed income portfolio. To conclude, we believe that the domestic variables are broadly under control with no imminent negatives in the offing. Crude has been under control. Inflation has been fairly orderly. It remains to be seen how the global factors pan out, which will obviously shape the future course of the monetary policy in India. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
आपका रोहन तो वाकई चैंपियन है, नेशनल्स खेलेगा एक दिन।
मैं तो इंटरनेशनल सोच रहा था।
क्या बात है, वर्ल्ड कप खेलोगे? शाबाश। हाँ भूमि बेटा, तुम बड़ी होकर क्या करोगी?
मैं तो जज बनूंगी। हाँ? सुप्रीम कोर्ट की जज।
इंडिया का फ्यूचर वाकई ब्राइट है।
अपने बच्चों के सपनों में आज ही से निवेश करें।
नई उम्मीद जब साथ मिले, रास्ते आसान हो चले, ख्वाहिशों को पंख लगा के आसमां में ये उड़ चले।
Financial advisors and distributors can gain access to services like basket of products, research, financial planning, e-Nivesh, online wrap solutions, portfolio monitoring, CRM, commission management, training, financial planning, and trailer monitoring. It serves as an efficient, low-cost, plug-and-play model for advisors to scale up their business in a standardized manner. Ifan also offers professional back-office services for product research, marketing, and legal and compliance. Ifan provides efficient online access to its clients, enabling them to monitor all investments under one roof. Manufacturers can access Ifan's widespread professional associate network across the country. The greatest benefit that an associate of Ifan would hold is with Ifan's assistance, he would be in a position to grow his business both in quality and quantity. Ifan's research-based B2B platform offers various asset classes, covering mutual funds, debt, equity, real estate, home loan, LAP, and LAS to over 50,000 clients through a 1,000 plus dedicated associates network in 87 cities in India. The company has been ranked in top 50 distributors in India amongst over 90,000 distributors in mutual fund. Ifan also ranks amongst the top 5 distributors in company fixed deposit mobilization. Being a large institute and aggregator has an advantage to negotiate with financial providers and thus offer higher short-term and long revenue to its associates. This also helps associates sustain their skilled manpower, thereby helping them increase their client base. As an associate starts increasing his network, he will have the potential to earn higher revenues across product classes. Ifan partners include a company that enables IFAs to gain greater efficiency and the ability to tap into economies of scale and at the same time help them deliver better service performance for their clients without increasing the cost. Ifan has taken the initiative to lead the change and facilitate a paradigm shift from the current sales-based advice to a more effective